It's important and imperative for our viewers that they really get to hear from market veterans, and it's important for us to bring that view out, because right now markets are volatile. Yes, the environment may not be conducive for equity as an asset class, but good news and good prices, they rarely come together. You should never waste a crisis. Sunil Singhania, before we get into specifics, let me get your worldview. Everyone has a view on China, but is China just a blip, not the end of the world?
So I think, Nikunj, you have to realize one thing. We are in a dynamic situation. There are so many countries in the world and there are so many factors. And it is very natural that some of the other country will obviously keep on having some of the other issues. Obviously, China is a very large country and therefore it is very, very important. Having said that, at least for now, we don't feel that there is something which is like a irreparable kind of a situation. Obviously, China has been growing very rapidly for the last 25-30 years. It started to grow a little bit slowly, and you will have some pain specifically for economies which are dependent on China as far as their exports are concerned. So yes, there is a little bit of a problem, but whether it is a very large problem, at least at this point of time, it doesn't seem to be so.
The problem for China were two. Number one, that they are slowing down, and number two, that they were looking at devaluing the currency. The Chinese central bank 2 days ago said that, look, we will not devaluate the currency. We will not do an engineered devaluation, and the growth numbers pretty much are indicating that the growth could be 5 or 6, but growth is still there. So our markets overreacting to the China problem.
Even Chinese yuan has depreciated by less than 4%. Yes. Indian rupee has depreciated, in the same period by almost that much. But if you see the last 8-9 years, from 5.5 rupee to a yuan, we are now over 10 rupees to a yuan. So technically, the Indian currency has depreciated against the yuan by 80-90%. I have not seen anyone talk about that, but 3-4% devaluation of yuan and everyone starts talking about it. So there will always be times when these factors are the talk of the moment. They tend to get a little bit over-analyzed, and then over a period of time people will tend to forget it. No one talks about Greece now.
So the bull market is intact. Let me ask you a simple question.
We are very optimistic on the Indian economy as well as the markets, So we don't see any major concerns. Obviously, no one likes the sharp corrections. Neither do we. But we have to live with it. It's not going to be. It's like a cardiogram. It will always be up and down. If it's a straight line, then you're not alive.
That's a great analogy. But the concern in that cardiogram is that when you go down, you don't know how much you can go down. And that's the problem because of flows.
So I think if you go down too much, then means you will need a bypass or an angiography. We don't see that kind of a situation at this point of time.
Even though flows are naturally moving away from emerging markets, I think foreigners, they own about $150 to $160 billion of Indian equities.
Foreigners own almost $350
billion
of Indian equities. Yeah. So see, you have to analyze again from a global perspective. The global equity markets are worth maybe $60-70 trillion, of which India is $2 trillion, which is like 2.5-3%, and flows are $350 billion, which is less than 1%. So to basically expect that any redemptions will lead to redemptions only from India, I think it's been discussed earlier also, but we don't see that going to be a case. In fact, relatively on a macro level, there are hardly any countries which have macros as positive as India has.
So I guess the debate on Indian macros is over. The debate is more micro, the debate is earnings now, and that's where I think it's a question mark. I'm not comparing Brazil and India. The macro story is great, but the problem is that earnings are not there, top line is still sluggish, and in terms of an economic acceleration, what was expected a year ago, that is not visible.
Yes, we are also disappointed with the earnings. We expected the earnings to start, inching up from March and June quarters. Obviously, the June quarter specifically was a little bit lower than expected. But we also have to see that the world has been so volatile. You had the Greece issues, you had the Euro issues, then you had sharp volatility in commodity prices, you had a sharp fall in crude price, which eventually will be very positive for India. But in the interim, there are companies which get hurt because of losses on the currency front, losses on the raw material front, and I think some sectors did get impacted because of that. The other thing is, Indian market is a sort of a two-sided market. There is one side where the earnings get positively impacted because of all this, and there is the other side where earnings get negatively impacted by all this. So if you see, on a consolidated whole market basis, you will see earnings have grown only 3-4%. But there is one half segment where earnings have grown 20-25%, and the other half segment where earnings might have contracted. So So I think stocks where there's been a growth in earnings have done well. Stocks specifically on the metal, infra pack where the earnings have not shown traction. They have anyway been trading at 3, 4, 5-year lows.
So we should not look at the aggregate picture. We should look at company-specific picture.
No, company-specific is more important. Yes, we have to look at the aggregate sector also because otherwise the market in a whole will not go up. But our view is that come September you will start to see a little bit of uptick in earnings. September generally is a weak quarter because the economic activity in the country slows down largely because of the monsoon season. But maybe December would be the quarter where hopefully you'll start to see the impact of both the government spending as well as the lower interest cost and lower fuel cost start to reflect in the profitability. One interesting thing in the June quarter numbers has been that the gross margins for a lot of companies have moved up.
Quality of earnings is improved.
Quality of earnings is improved. The top line has not been all that great because one, inflation has been negative, and second, volume growth has not taken off the way we all expect. Once that happens, I think the operating leverage will also start to play.
But the core data, whether it's IP or the the trade data, is not indicating that earnings recovery has happened. Government spending has gone up, yet there is no pickup in investment cycle. So are we far away from an economic pickup?
See, it always takes time. Whenever the spending happens, you need to have a multiplier effect. So 1 rupee spent eventually becomes 5 or 7 rupees, in terms of spending overall, because there's a multiplier effect. That multiplier effect is still to be visible. One is because over the last 3, 4, 5 years, nothing major has happened. That's why the companies also are a little hesitant. I mentioned to you earlier that capacity utilization is not all that great. So there is again hesitation from the company's perspective to spend more on capacity increase. I think it will eventually start to happen. And we don't have to look far behind. The same scenario was prevalent between 2001 to 2003. And then when the growth started, you see 2004 and 5, earnings growth were almost 25-27% every year. So it takes time, and by heart we are optimist. We believe that India is going to go to a $4 trillion in economy size, and all these things will happen. It's a matter of 1 or 2 quarters here and there.
So this is just a pause. I mean, your unit holders and the viewers, they should not panic. I want to hear from your mouth. And why should they not panic?
In fact, Indian investors have been very, very smart. Even in the current fall, in fact, August was a great month.
Money is coming in.
In fact, money has been coming in. In the past, people have panicked and withdrawn at the wrong time. This time, in fact, investors are using this opportunity to increase their positions in the Indian equity market. So I think investors are smart, and very clearly, as I mentioned earlier, we are a $2 trillion economy. We are going to be a $4 trillion economy. It's a matter of 7 or 8 years. I think a lot of wealth will be created.
That's largely because the fund performance has been superior. Your fund is up 10% in this year versus what has happened to the market.
So I think yes, the markets have become negative on a 1-year perspective. Touch wood, the funds have been performing reasonable, and that is exactly what I was trying to say. There is one category of stocks which are doing well, and there is one category of stock where hope was more rather than fundamentals, and those are the stocks which have fallen more.
Give me an example of where there is still a lot of hope and you don't see earnings visibility. Which are those groups? Which are those clans?
I would not like to.
You can tell me sectors of groups.
So I think infrastructure is a great opportunity in India, but at the same time there are companies where balance sheets are beyond repair. We would not like to be hopeful on those companies, though we have great expectations from the infrastructure sector in India. Similarly, metal has become a global commodity, so it is okay to do a stock specific analysis, but ultimately you have to have a view on what the price trends are going to be globally, and I think if you have that, then it makes sense to be overweight that. Otherwise, it's very difficult.
But your view on commodity cycle is bearish.
We are not experts on the commodity cycle, and our view would be that use this as trading opportunities unless you see firm trends which show that demand is rising more than the production, which is not right now seen, and we don't see that it's going to happen for the next 1 or 2 years. Stock prices might start to get reflected a little bit earlier. The government is also trying to do something to protect the Indian industry. At least in the near term, that would be some kind of a solace for these companies. But whether global demand is picking up in a big way, we don't see that.
Is it time to be a contra buyer in PSU banks, because they've just fallen so much? that some of these banks are almost pricing in bankruptcy. Indradhanush is a measure which government is trying to do. So selectively, would you be nibbling at PSU banks?
Nikunj, we have been in this market for so long and we have made so many mistakes. I think one thing which we have learned is don't repeat your mistakes.
So PSU banks, no.
No, I'm not talking about PSU banks, but just because the stock or sector has fallen, should we be buying it? I don't think that is the case. Having said that, I think a few PSU banks, specifically the larger ones, have a great, fundamental DNA. But whether to buy every PSU bank just because they have fallen, I think we would not be in that camp.
Right now markets are taking shelter in quality stocks, and that's typical. Whenever there is panic or volatility in the market, quality stocks, they outperform. So when will markets really churn from quality to growth? Because these quality, when I say, high return on capital, high return on equity companies, they've done extremely well for the last 4 or 5 years. They cannot go up endlessly. I mean, trees don't go to sky.
So yes, there has been a shift towards quality, but having said that, I think over the last 1 or 2 years, there has been, a spread out in terms of performance, across sectors. Specifically say on the pharma side, you might say that the sector has become overpriced. But if you see, the growth rates have been phenomenal, and the currency is also helping as a tailwind. So it's not only because they have high ROEs or that's why they are doing well. It's also because the fundamentals have been continuously improving. So as long as the fundamentals keep on continuously improving, I think this distinction between quality and non-quality, I think will go away.
The idea is to focus on earnings.
And frankly, as an investor, you would like to own the best stock. It might be not the best quality, it would be reasonable quality, but at a good price. So I think a very good quality stock at a very high price is not going to give any returns. So you have to strike a balance between valuation as well as quality. You've
been an early entrant in pharma. My compliments on that. You identified the entire generic opportunity much ahead of world actually understood it. And you've been consistently bullish on pharma stocks selectively. But there are two basic issues with the pharma sector now. One, US generic prices are coming down, and US FDA has been much more stringent. So aren't these real-time issues which you need to grapple with now?
So one is, yes, as the Indian pharma companies grow in size, they will have enhanced scrutiny. But having said that, I think Indian pharma companies also generally have grown with time. The quality focus has been pretty high. And if you see, despite all this enhanced scrutiny from FDA, I think Indian pharma companies have been the fastest growing globally. So I think these are the short-term sort of challenges. Good companies will come out of it and will continuously keep on growing. In fact, the generic opportunity is only growing, and Indian companies have raised themselves in terms of now being there in terms of the first to file opportunities, in terms of more B2C business rather than only supporting on the API side. So I think they have been growing, and now the last bit is they have started acquiring front-end companies. So which would mean that they would become more sort of dominant even in the B2C side of the business.
Last time when we met, you told me IT was cheap. IT underperformed first and now seems to be outperforming. My issue with IT is that the IT pie, and I'm looking at Gartner number, seems to be contracting. Indian companies are going because they are gaining market share. Can that continue endlessly?
I don't know whether it will continue endlessly, but whether it will continue for the next 5-10 years, we definitely feel.
So you're happy to own IT?
So at 15p, with a tailwind again of currency, 15p is discounting rupee at 61, 62, rupees already touching 67. There is a move toward digitization globally. There is a move towards adopting new technology. There is a move towards digital banking, and all these are huge opportunities for Indian IT. There is a move towards doing more innovation on the manufacturing, on the motor car side. Earlier, car was 5% IT, 95% mechanical. Yes. It's now reversing. You have more IT, with driverless cars and all moving up. So I think IT as a segment will continuously have opportunities. And as I said, at 15p free cash flow with a tailwind of rupee, we believe that it's a decent.
There were two smart identifications by your AMC a couple of months ago. Number one was textiles, and that sector has done well. Second was urban consumption, and I distinctly remember you told me that you believe urban consumption will make a comeback because inflation is coming down. Are those themes still intact?
100%. Textile, I think as a segment, the stocks have moved up very sharply. So maybe, you know, there might be a pause, but again, you know, there is a tailwind of currency. There is also a tailwind because raw material prices as well as power costs, which are very important, are coming down. On the urban consumption, you know, there has been a big saving for the urban consumer in terms of inflation, big saving in terms of fuel cost, and that should also start to show in the consumption pattern. The other thing is hopefully the job market should revive, which it's already started to do in some segments, and that should also you know, aid urban income and therefore urban consumption.
Now you've seen many of these crises, whether it's 1999 crisis or what happened in 2008 or what happened when tapering was announced. So in terms of a magnitude, how big this problem could be?
So one is this crisis have made you stronger,
okay,
and made you calmer. Second is, you know, we analyzed last 15 years major corrections.
That was a lovely note.
Yeah, so thank you. So except 2008, when it was like a 1 in a 200-year kind of an event, we have seen that markets in a structural, you know, uptrend do tend to correct by almost 15%, which is what the current correction has also.
So all bull markets correct.
I mentioned to you earlier, you know, cardiogram will always be up and down.
Okay,
it can't be only up.
No, I'm just asking a basic question because it's important that we get
It's
this
not only in India.
for our viewers.
If you see the history of the global equity markets, you know, China grew 25 years at 9% plus, but there were 4 or 5 instances when it corrected sharply. Japan grew at 8% plus for 30 years, and there were 2 years where, you know, the economy in fact became negative, not only the markets. So same is the case with Korea, and same is the case with even US, which had a phenomenal run from, you know, 2000 to 2010. So this is a part and parcel of markets, and you have to be prepared. And we always say that, you know, make volatility your friend rather than get scared with it.
So I won't ask you a short-term question, but let's understand a medium-term time frame. And when I say medium-term time frame, 2 to 3 years. So for those who are planning to buy stocks now, and from a 2 to 3 time year frame, where do you think markets would be?
So again,
economy would be.
Yeah. So again, you know, we have this simple, you know, thing. We are behind the world by 15-20 years, and I think that's an opportunity for us to learn. So there is only 15 economies in the world who have $1 trillion in economy size, of which only 9 have graduated to the $2 trillion mark, of which India is one, and only 3 have been able to graduate to the $4 trillion mark. Our view is that India went to 1 trillion in 60 years. The second trillion came in 7 years, and the next 2 trillion will come again in 7 years. So the wealth which we have created over the last 67 years, we would double that in the next 7-8 years. And I think that is a big sort of picture to keep in mind. If someone has a doubt on that, then they should stay away from investing in anything in India. But if you believe that instead of 7, it might take 8 or 9 years, I think it's the still good 15% kind of return which you should expect from Indian equity markets.
Do you think somewhere we are just undermining what domestic investors or domestic funds are doing? Because, you know, we get fascinated with this term called Gora Paisa. But foreigners have been selling. They've been relentless sellers in the month of August. September also data is not that encouraging. But mutual funds, LIC, insurance firms, they are really backing this market. Is that the trend which could be a big trend and a game-changing trend now?
One thing we have to realize, you know, Nikunj, is that world is flat. Money is the same. Funds globally move in the same direction at the same time in the same geographies. We have seen a good amount of redemptions in August, predominantly in the developed market funds also, and also in the emerging market fund. And again, we have to realize one thing, that there is a shift in wealth. Wealth is shifting from oil producing countries to oil consuming countries. So, you know, the oil producing countries are facing some stress, and they have been large investors through their sovereign wealth arms into equities globally, and they have had to sell some equities to meet their own you know, economic deficits, and there has been some redemptions. We should be prepared for that. I think India will be a part and parcel of that. I was in New York a week back, and one interesting thing which I noticed when I met funds there was that they have now started looking at country-specific funds again, which they had stopped for the last 7-8 years.
So you're working on holiday also?
It was not a holiday. It was a mini personal visit, and then 3-4 days I was there for work also.
But the message you've come back with is that India could be an asset class in itself. We may not be part of the
There would be few countries
market,
which would be again, you know, specifically being looked at by investors. And as you rightly said, you know, domestic investors are there. We are a country with huge savings. We save almost $500 billion. And again, in India, the clear trend is move away from physical savings to financial savings. So real estate is out, gold is out, money is moving to fixed income, money is moving to equities, and I think that's very healthy for the economy as a whole.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNow Live. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.